Welcome, everyone. My name is Kenny Burch. I'm a tax director in our mortgage banking practice. Today, we're discussing how mortgage lenders are using sign-on bonuses, retention bonuses, and related recruiting incentives to attract and retain top talent, especially loan originators and production leaders, while also managing tighter margins. We'll cover the business case, pros and cons, tax and payroll treatment, forgivable loan risk, clawbacks, and make-whole arrangements. To help me with this conversation, I have Gina Jackson, a partner from our mortgage banking tax practice, joining me again. Hi, Gina.
Hi, Kenny. I am definitely looking forward to our conversation and hope that there are a few helpful takeaways for the viewers.
Great. Glad to have you. Gina, let's start with the business reason. Why are lenders leaning on sign-on and retention bonuses and the current mortgage market?
As many are aware, the mortgage market remains highly competitive for experienced originators, branch managers, and sales leaders with those strong referral networks. Sign-on bonuses can help lenders recruit proven talent quickly, while retention bonuses can keep key employees from leaving during, say, periods of low volume, organizational restructuring, or margin pressure. From a finance perspective, the goal is to shorten ramp-up time and protect revenue-producing capacity, but in a tighter margin environment, every dollar matters along with key personnel. So oftentimes a bonus program is utilized to leverage skills and increase profitability.
Yeah, I think that's a great distinction. Traditional bonus plans usually focus on performance, emphasize the importance of clear, suitable goals, objective measures, clear eligibility, and allocation rules, and also reasonable timeframes. I think these sign-on bonuses and retention bonuses are geared more towards attracting and retaining talent. If you're considering other ways to attract and retain talent, check out our other video covering equity-based compensation and deferred compensation agreements.
Yes, and definitely keep in mind these programs can be effective, but they should be built with input from finance, HR, legal, tax, accounting, and compliance. Without that cross-functional review, lenders may miss opportunities or unintentionally create risk.
Yeah, that's a great point, Gina. Let's talk about the pros and cons of these bonus plans. You want to start with what the advantages are for lenders?
Yeah, the biggest advantages are really speed and competitiveness. A well-designed sign-on package can help a lender compete for high-performing originators who may have existing compensation, pipeline, or clawback arrangements with a prior employer. Retention bonuses can also be less expensive than turnover. Replacing a top producer can mean lost pipeline, disrupted relationships, recruiting fees, licensing delays, training time, and lost production. If the bonus is structured around continued service and profitable production, it can help stabilize the platform.
Yeah, it sounds like a key to success is a well thought out program. We often see these programs also create flexibility. Lenders can use strategic bonus strategies rather than broad-based salary increases, which may be harder to reverse when volume declines.
Yes, and targeted awards can be more efficient than across-the-board compensation increases, but only if the lender has disciplined approval and ROI tracking.
Yeah, that makes sense. You want to talk about some of the disadvantages?
Yeah, the first downside is cost. The face amount of the bonus is not really the all-in cost. Sign-on and retention bonuses are generally treated as wages subject to federal income tax withholding, FICA, and FUTA when they're paid in connection with the employment relationship. And, sources note that label signing bonus is not controlling if the payment is remuneration for employment.
Yeah, that makes sense. What about internal equity risk?
Definitely. If new hires receive large sign-on packages while existing employees receive less, that can create morale issues. And retention bonuses may also create that stay until paid behavior if the plan is not paired with meaningful long-term engagement and profitability goals.
That's so true. I mean, if lenders only reward volume alone, it may worsen margins.
Yes, and a lender does not want to pay premium incentives for personnel if their loans are unprofitable, poorly documented, or likely to create repurchase, compliance, or even servicing risk.
All right. Let's go deeper on the tax side. How should lenders treat sign-on and retention bonuses from a payroll perspective?
Yeah, as a baseline, these payments are usually wages. IRS guidance treats amounts paid for signing an employment contract or otherwise establishing or modifying the employment relationship as wages subject to withholding, FICA, and FUTA, unless a specific exception applies.
Yeah. So the key question is whether the employee provides clear, separate, adequate consideration that is not dependent on the employer-employee relationship, right? If the payment is connected to employment, lenders should generally expect wage treatment.
Yes, and timing matters too. Payroll taxation generally applies when wages are paid and received, and the employer must use the applicable FICA and withholding rules for that year. Also, payments to former employees can still be treated as wages if they relate to prior employment.
Great. What about income taxes? What do you think businesses need to know there?
A common misconception here is that payroll tax and income tax rules align in situations like this, but often that's not the case. For income tax purposes, deductibility of compensation, including bonuses, typically refers to services actually rendered. When it relates to sign-on or retention bonuses, services are not considered actually rendered until the period of the contract, so typically ratable over the period. Essentially, economic performance occurs as that person provides the service. And so as such, often these payments are really advanced payments for services and deducted over the term. But ultimately, these structures are very facts and circumstances driven. Not all fall into this exact fact pattern and treatment. So know that an in-depth review, planning, and strategic alignment will make the plan best meet your business needs.
That's great, Gina. Let's switch gears here and discuss something I know I'm asked about a lot. You are probably too. We see a lot of lenders use forgivable loans or advances to recruit top originators. What do you think the risks are there?
The risk is that the IRS may treat the arrangement as compensation rather than a bona fide loan. There are instances with the IRS where upfront payments structured with a promissory note and a matching bonus agreement were treated in substance as compensation because repayment was effectively satisfied by guaranteed bonus offsets and service-based forgiveness. The principle here is that a bona fide loan should include that unconditional and personal obligation to repay. If the economics show that repayment's unlikely, circular, or even dependent primarily on continued employment, the form may not control.
Yeah, that's something great to know, Gina. I've seen in the guidance where an employer has history of forgiving advances, they don't enforce repayment, or they structure repayment through guaranteed bonuses. In that case, the IRS may scrutinize the arrangement as disguised wages.
Especially where the advance and the forgiveness are in the same document and pre-planned. That definitely can create risk. There's also deduction timing risk. In some cases, the employer cannot deduct the full upfront amount immediately. Economic performance principles can cause the cost to be incurred as the employee performs services over the term, so much like the sign-on or retention bonuses.
Yep. And then I know a lot of these arrangements include a clawback provision. What happens if a lender offers to cover a candidate's prior employer's clawback, or they require a clawback of their own?
Clawbacks are common, but they create tax and employee relations complexity. If an employee repays a bonus in a later year, the employee generally cannot just simply reverse the prior year income inclusion. So the result can be administratively and financially difficult for the employee. Also, if a new employer pays the clawback on behalf of the employee, that payment's generally taxable to the employee and then may trigger, additional withholding and payroll tax obligations. If the lender grosses up the employee for taxes, then that all-in cost can increase significantly.
I agree. That's a great point. I think lenders should also consider whether clawbacks will be enforced in practice. Non-enforcement can definitely weaken the lender's position that an arrangement is a true repayment obligation. Gina, just one final question for you today. What do you think lenders should do before rolling out or renewing these programs?
Yeah, lenders should definitely model the economics, include, payroll taxes, potential gross ups, expected production, margin, pull through, repurchase risk, and even accounting treatment. Design the program carefully, define eligibility, performance metrics, service periods, repayment terms, documentation, and approval authority, and avoid those structures that appear to be loans in form, but compensation in substance. And then again, definitely coordinate across departments. These programs touch tax, payroll, accounting, HR, legal compliance, licensing, and operations.
Thanks, Gina. And thanks for joining us in this conversation. We'd encourage you to talk through these types of structures with Richie May or your tax provider, as there can be pitfalls, as we discussed. But if done correctly, these strategies can definitely make a big impact on your operations. If you have any questions, please reach out to us at info@richiemay.com.